Welcome back to CMA USA Exam Coach, your trusted study partner for mastering your CMA. In this episode, we're moving into the final section of our Working Capital Management series, Short-Term Finance Management. So far, we've seen how companies manage cash, marketable securities, receivables, and inventory. Now, we focus on the other side of working capital, how companies meet their short-term financial needs. Let's understand this in simple terms. Every company needs money for day-to-day operations, like paying suppliers, covering wages, purchasing materials, or meeting utility bills. But what if there's not enough cash on hand? That's where short-term financing comes in. These are temporary funding sources that help the company fill the cash gap, usually for less than 1 year. Whether it's borrowing from banks, delaying payments to creditors, or issuing short-term papers, companies must manage these sources wisely to maintain liquidity and avoid financial stress. Let's take a quick look at the different types of short-term financing that companies use. These are the tools and methods businesses rely on when they need funds to support their day-to-day operations. In this episode, we will be covering the following key sources of short-term finance. First, trade credit. This is the most common and natural form of credit, where suppliers allow companies to buy now and pay later. Next, short-term bank loans. These are quick borrowings from banks that need to be paid back within a short period, usually less than a year. Then, we have the line of credit. This is like a flexible loan from a bank that a company can draw from whenever it needs cash, up to a certain limit. We'll also discuss transaction loans, which are loans given for specific purchases or activities, often with fixed repayment terms. Then comes secured loans. These loans are backed by collateral, like inventory or accounts receivable, making it less risky for lenders. And finally, we'll explore other types of short-term financing, such as factoring, inventory financing. In the upcoming slides, we'll discuss each one of these sources in detail, how they work, why companies use them, and what the pros and cons are. Let's begin our discussion with trade credit, also known as accounts payable. Trade credit is one of the most common and convenient forms of short-term finance available to businesses. And the best part? It doesn't even require a formal loan agreement. So, what exactly is trade credit? Trade credit is a spontaneous source of finance, meaning it arises naturally as a part of normal business operations. When a company purchases goods or services from a supplier on credit, it doesn't pay immediately. Instead, the supplier allows a period, say 30 or 60 days, to make the payment. This unpaid amount becomes the company's trade credit or accounts payable. For example, let's say a retail store buys inventory from a supplier today, but the supplier allows payment after 45 days. During those 45 days, the store is technically using the supplier's money to run its business. That's trade credit in action. It's a form of interest-free financing, at least until the due date, making it a very attractive short-term funding source. However, some suppliers may offer a discount for early payment, so delaying payment might result in missing out on that discount. Trade credit also reflects the company's reputation and credibility. A business with good standing can negotiate better terms and longer credit periods. It's important to remember that although trade credit doesn't involve a loan from a bank, it's still a liability that the business must plan for and repay on time to maintain good supplier relationships. In summary, trade credit is a natural and cost-effective short-term financing method that supports working capital and daily operations. Now let's move on to the second type of short-term financing, short-term bank loans. As the name suggests, these are loans provided by banks or financial institutions that must be repaid within a short period, usually within 1 year. These loans are typically used to meet temporary cash flow shortages or to finance seasonal needs in a business. For example, if a company needs to purchase raw materials in bulk to fulfill a big order, but it doesn't have enough cash on hand, it can take a short-term bank loan to manage this need. These loans are usually structured with a fixed interest rate and specific repayment terms. The repayment might happen in one lump sum at the end of the term or in installments, depending on the agreement with the bank. Short-term loans are also negotiated directly with the bank, and the company's creditworthiness plays a major role in whether the bank approves the loan and at what interest rate. In some cases, the bank may ask for collateral, or they might issue it as an unsecured loan if the borrower has a strong financial background. Keep in mind, although short-term loans are useful for immediate funding needs, they do come with interest costs, and timely repayment is crucial to maintain good banking relationships and avoid penalties. So in summary, short-term bank loans are structured interest-bearing borrowings that help businesses manage their short-term liquidity requirements, especially for urgent or seasonal needs. Now, before we go further into short-term financing options, it's important to understand two key concepts related to borrowing and investing: simple interest and compound interest. Let's begin with simple interest. Simple interest is the most basic type of interest. It is calculated only on the original amount of money that is borrowed or invested, which we call the principal. This type of interest does not change over time because it's always based on that same initial principal amount. So, if you borrow money or invest under simple interest, your interest earnings or payments remain consistent throughout the period. Now moving on to compound interest. Compound interest is a little more dynamic. It's the interest that is calculated not just on the original principal, but also on the interest that has already been earned or added in previous periods. In simple terms, you earn interest on interest. Over time, this makes a significant difference. Compound interest grows faster than simple interest because each time the interest is added, it increases the amount on which future interest is calculated. This is especially important when evaluating the true cost of a loan or the real return on an investment, especially in cases where interest compounds monthly, quarterly, or annually. Let's now look at the basic equation used to calculate compound interest. The formula is A equals P multiplied by 1 plus R divided by 100 raised to the power of N. Let's break this down. A stands for the total amount to be repaid or received at the end of the investment or loan period. P is the principal amount, which is the original amount invested or borrowed. R represents the rate of interest per year, expressed as a percentage. N is the number of years for which the money is invested or borrowed. This formula helps us calculate the final amount, including both the principal and the interest earned or accrued over time. So again, this is not just interest on the original amount, but on the accumulated balance year after year. That's why we say compound interest grows faster than simple interest. It builds upon itself. This is especially relevant when dealing with long-term or rolling short-term borrowings, where understanding the full financial impact is critical. So to summarize, simple interest is straightforward and constant, while compound interest increases over time due to accumulation, and that makes a big difference in real-world financial decisions. Let's now understand the concept of loan with compensating balances. Sometimes, when a company borrows money from a bank, the bank may require the borrower to keep a certain percentage of the loan amount in their bank account. This amount is called the compensating balance. It acts like a form of security or reserve that cannot be used by the borrower during the loan period. The bank may also consider it as part of the relationship to reduce their risk or to cover processing fees or other charges. Now here's what's important. Even though the borrower receives a loan of, say, $100,000, if they are required to keep $10,000 as a compensating balance, they only get to use $90,000. This means the effective loan amount available to the borrower is less than the face value of the loan. So the actual interest cost on the usable funds becomes higher. In other words, the effective interest rate increases because the borrower is paying interest on the full loan amount but is only able to use a part of it. So, compensating balances reduce the net proceeds for the borrower and increase the true cost of borrowing. Let's discuss when no interest is paid by the bank on compensating balance. In this case, the bank does not pay any interest on the compensating balance that the borrower is required to keep with the bank. So what exactly does this mean? When a borrower takes a loan, the bank asks them to keep a fixed portion of that loan amount as a deposit in a special account. This is called the compensating balance. But here's the key point. In this scenario, the bank does not offer any interest on that balance. So essentially, the bank is holding a portion of the borrower's money without paying anything back for it. From the bank's perspective, it's a form of added security or an assurance against the loan, and from the borrower's side, this reduces the effective cash they receive from the loan. The practical implication? The borrower receives less money in hand, but still pays interest on the full loan amount, which increases the effective cost of borrowing. Let's now understand how the stated interest rate and the effective interest rate can differ in a loan agreement, especially when there is a compensating balance involved. Let's take a simple example. A company takes a one-year loan of $100,000 at a 6% simple interest rate. However, the bank has a condition. The company must keep $20,000 as a compensating balance in the bank. And remember, the bank does not pay any interest on this compensating balance. So, how does this affect the actual cost of borrowing? First, let's calculate the interest amount based on the stated rate. Interest is equal to $100,000 multiplied by 6%, which is $6,000. Now, here's the important part. Even though the company borrowed $100,000, it can't use the full amount. Because $20,000 must stay in the bank, the company effectively has access to only $80,000. So, the effective interest rate is the $6,000 of interest divided by the usable funds, which is $100,000 minus $20,000. That gives us $6,000 divided by $80,000, which equals 7.5%. That means, even though the loan is advertised at 6%, the actual cost to the borrower, or the effective interest rate, is 7.5% due to the impact of the compensating balance. This is why it's important to always consider the terms and not just the stated rate, because the true cost of borrowing may be higher than it looks. Let's now turn our calculation into a formula that you can use in similar scenarios. When the bank requires a compensating balance and does not pay any interest on it, we calculate the effective interest rate using the following equation. Effective interest rate equals the interest amount, which is principal multiplied by the stated interest rate, divided by the actual usable funds, and that's the principal minus the compensating balance. So the formula becomes effective interest rate equals principal times interest rate divided by principal minus compensating balance. This equation helps us understand the real cost of borrowing when you don't have full access to the loan amount due to compensating balance requirements. In the previous case, we saw that the compensating balance kept with the bank did not earn any return, so the effective cost of borrowing was higher. But now, let's look at a more favorable situation for the borrower. This time, the bank does pay interest on the compensating balance. That means, even though the borrower is required to keep a portion of the loan in the bank as a security, that amount is not idle. It earns some return, which helps reduce the overall cost of borrowing. This interest income, received from the bank on the compensating balance, partially offsets the interest paid on the loan. So, compared to the previous case, the effective interest rate will now be lower because the borrower is recovering a part of the interest through the interest earned on the compensating balance. We'll see how this works with an example in the next slide. But for now, just remember this key idea. When the compensating balance earns interest, the effective cost of borrowing decreases compared to when it earns nothing. Now, let's understand how to calculate the effective interest rate when the bank pays interest on the compensating balance. Here's the situation. The borrower takes a loan of $100,000 at an interest rate of 6%. The bank requires the borrower to maintain a compensating balance of $20,000, and on that balance, the bank pays 2% interest. Let's calculate it step by step. First, let's find the interest paid on the loan. Interest equals $100,000 multiplied by 6% equals $6,000. Now, since the bank pays 2% on the $20,000 compensating balance, the borrower is earning interest income. Interest income equals $20,000 multiplied by 2% equals $400. So, the net cost to the borrower is $6,000 minus $400 equals $5,600. Now let's find the effective interest rate. The borrower receives only $80,000 in hand because $20,000 is kept as compensating balance. So, we divide the net interest cost by the actual usable funds. Effective interest rate equals $5,600 divided by $80,000. That gives us an effective interest rate of 7%. So even though the nominal rate is 6%, the effective cost becomes 7% because the borrower has access to only 80% of the total loan amount, even though he pays interest on the full amount. This example clearly shows how interest paid on compensating balances can reduce the overall borrowing cost, but still makes the loan more expensive than it appears at first glance. Now let's take a moment to look at the equation we just used in a general form. When interest is paid on the compensating balance, the effective interest rate can be expressed using this equation. Effective interest rate equals principal times interest rate minus compensating balance times interest rate received from bank divided by principal minus compensating balance. Let me say that again in plain terms. We first calculate the total interest you are paying on the loan. That's the principal amount multiplied by the interest rate. Then, we subtract the interest income that you are receiving from the bank on the compensating balance because that's reducing your net cost. Next, in the denominator, we look at how much money you are actually receiving and using, which is the principal amount minus the compensating balance. Because remember, the compensating balance is not available for your use. So what we are really doing here is we are finding the net interest cost and dividing it by the net usable loan amount. This gives us the true or effective interest rate. But here's an important point for all CMA students. You don't need to memorize this formula. Instead, understand the concept behind it. It's all about calculating how much you actually pay after considering the earnings on compensating balance and how much money you truly get to use. So, once you understand that concept, you can solve any question like this easily, even without by-hearting the equation. Now let's look at another form of short-term financing. This is called a loan with discount interest. In a discount interest loan, the interest is collected upfront by the lender, that is, before the borrower even receives the loan amount. Here's how it works. Suppose you apply for a short-term loan. In this case, instead of giving you the full loan amount and collecting interest at the end of the term, the bank calculates the interest in advance, subtracts it from the loan, and then gives you the balance amount. So, for example, if the loan amount is $100,000 and the interest is 6%, the bank will deduct $6,000 right away, and you'll actually receive only $94,000 in hand. But remember, you still have to repay the full $100,000 at the end of the term. That's why this type of loan increases the effective interest rate, because you're paying interest on the full loan, but you're only getting to use part of it. So the key idea here is, discount interest loans reduce the actual usable funds for the borrower while keeping the repayment fixed at the full principal. This makes it more expensive than it may first appear. And that's exactly what we will calculate with an example. Let's solve a sample question on discounted interest loans. Suppose a loan of $100,000 is issued with a 4% discounted interest rate. First, we calculate the interest amount by multiplying the principal by the interest rate. That is $100,000 times 4%, which equals $4,000. Because this is a discounted interest loan, the interest is deducted up front, so the borrower actually receives $96,000. However, they must repay the full $100,000 at the end. This means the effective interest rate is higher than the nominal rate of 4%. To find the effective interest rate, we divide the interest amount, $4,000, by the net amount received, $96,000. This gives us an effective interest rate of 4.16%. So even though the nominal rate is 4%, the actual cost of borrowing is 4.16%, reflecting the upfront deduction of interest. The effective interest rate can be calculated by dividing the interest amount by the principal minus the total interest deducted. This shows the true cost of borrowing because the borrower actually receives less than the principal amount, but repays the full principal. From all the types of loans we've discussed, one thing is clear. The effective interest rate is all about what we actually pay versus what we actually receive. Instead of memorizing different formulas, just understand the concept. Effective interest rate simply means the interest paid divided by the actual amount we received from the loan. So, the summary equation is, effective interest rate equals interest paid divided by actual amount received. Once you understand this idea, you don't need to worry about by-hearting each version of the formula. Just apply this logic and adjust it based on the loan type. Let's understand what an installment loan is. An installment loan is a type of loan where the borrower agrees to make equal monthly payments over the entire life of the loan. These payments are made regularly, usually each month, and continue until the loan is fully paid off. Each of these monthly payments is made up of two components: a portion that goes toward paying interest, which is the cost of borrowing, and the rest goes toward reducing the principal, which is the original amount of the loan. So you're not paying only interest at first and principal later. Every monthly payment includes both. Now, let's look at what the term monthly installment really means in financial terms. The monthly installment is calculated in such a way that If you take the value of each of these future payments and discount them using the loan's stated interest rate, the total present value of all these payments will be exactly equal to the original loan amount. This simply means the value of what you're paying in the future, adjusted to today's value using the interest rate, should be the same as what you borrowed. This way, by the time you finish all the monthly payments, you will have completely repaid both the principal and the interest. Understanding this idea helps you see how loan repayment is structured and why each payment is fixed, even though the mix of interest and principal inside each payment changes over time. Let's now go through a sample question to understand how to calculate the monthly installment, or what we call the EMI-equated monthly installment. In this question, we are given that the principal of the loan is $10,000. The interest rate is 12% per year, and the duration of the loan is 1 year with equal monthly payments. Our goal is to calculate the monthly installment amount, or EMI, which will fully repay this loan over 12 months. Let's begin. We'll assume that the monthly installment is X. Since the loan is for 1 year and payments are made monthly, there will be 12 equal installments. The annual interest rate is 12%, so the interest rate per month is 12% divided by 12, which gives us 1% per month. Now here's the key part: we need to find the value of X, the monthly payment, such that the present value of all 12 payments discounted at 1% per month equals the loan amount, which is $10,000. This is the core idea of how EMIs work. We are spreading the repayment of both principal and interest evenly across all months, but making sure that the total present value of all future payments adds up to the original loan. To do this, we use the present value of an annuity formula, or we can use the annuity factor from a table or calculator. We're told that the annuity factor for 12 periods at 1% is 11.255. So, we multiply the monthly installment as X by this annuity factor. That gives us X multiplied by 11.255 equals 10,000. To find the monthly installment, we divide 10,000 by 11.255. That gives us an EMI of $888.49. So, the final answer, the monthly installment required to repay this loan in 1 year, with 12 equal payments at 12% annual interest, is $888.49. This method ensures that by the end of the 12th payment, both the principal and interest are fully paid off and the loan is closed. Now let's talk about a common short-term financing option, known as a line of credit. A line of credit is a financial arrangement between a borrower and a bank, where the bank agrees to make funds available up to a predetermined credit limit. This means the borrower can withdraw money as needed anytime up to that approved limit. They don't have to take the full amount all at once. Instead, they can borrow only what they need when they need it. For example, if the approved credit limit is $20,000, the borrower can choose to withdraw just $5,000 today, another $3,000 next week, and so on, as long as the total outstanding amount doesn't exceed the $20,000 limit. The best part is, interest is charged only on the amount actually used, not on the total credit limit. So if you borrow $5,000, interest will be charged only on that amount, not on the full $20,000. Also, when the borrower repays a portion or the full amount, that limit becomes available again. This makes the line of credit a revolving facility, meaning you can reuse it over and over within the agreed terms. This arrangement gives businesses a lot of flexibility. It helps manage short-term cash needs, handle temporary working capital gaps, or deal with sudden expenses without having to apply for a new loan each time. To sum up, a line of credit is a flexible borrowing arrangement where the bank allows financing up to a set limit, and the borrower can draw funds as needed, paying interest only on what they actually use. Let's now take a closer look at a specific type of credit arrangement called a revolving line of credit. A revolving line of credit works very similarly to the general line of credit we just discussed, but with one key feature. Once you repay the amount you've borrowed, that credit becomes available to use again. This is why it's called revolving. The credit keeps rotating or replenishing as you repay what you've used. For example, let's say you have a revolving credit limit of $5,000. If you use $2,000 from it, you still have $3,000 left to use. Now, if you repay $1,000, your available credit increases again. Now you can borrow $4,000 in total. A common and relatable example of a revolving line of credit is a credit card. With a credit card, you are given a fixed limit, let's say $3,000. You can spend up to that amount on purchases or withdrawals. At the end of the billing cycle, you get a statement showing how much you owe. You can repay the full amount or make a minimum payment. Once you repay, that amount becomes available to spend again. So, unlike a term loan, where you borrow once and repay in fixed installments, a revolving line of credit is much more flexible. It allows you to borrow, repay, and borrow again, without needing a new loan application each time. However, it also requires discipline because interest is charged on the amount you use, and if not managed properly, it can lead to high interest costs. In short, a revolving line of credit is a reusable source of funds where repayment restores the credit limit, and the most common everyday example is a credit card. Now let's understand what a non-revolving line of credit is and how it differs from the revolving one we just discussed. A non-revolving line of credit is a type of credit arrangement where the borrower can draw funds up to a certain limit, just like in a regular line of credit. But with one important difference. Once you use the credit, that portion does not become available again, even after you repay it. In other words, the credit limit reduces permanently as you use it, and it does not automatically refresh like a revolving line of credit. A home improvement loan or project-based line of credit given by a bank where you can draw funds as needed, up to a limit, but once used, that part is no longer available, even if you repay it. Now here's how it works as a non-revolving credit. Let's look at a practical example. Say, a business is approved for a $50,000 non-revolving credit line to fund equipment purchases. If they withdraw $30,000, they'll have only $20,000 left to use. Even if they repay the $30,000, their credit limit remains at $20,000. It doesn't reset. This is very different from a revolving line of credit, like a credit card or a bank overdraft, where repaid amounts become available to use again. So, in summary, a non-revolving line of credit allows you to borrow up to a limit, but once you use a portion of it, that portion is no longer available for reuse unless the bank specifically resets the limit. Let's now go through a sample question to understand how to calculate the effective interest rate on a line of credit, especially when the bank also charges a commitment fee on the unused portion. Here's the scenario. A company has arranged a line of credit of $1 million. The interest rate on the borrowed portion is 8% per year. In addition to that, the bank charges a commitment fee of 0.25% per month on the unused portion, that is, on the amount not borrowed. Now the company borrows $550,000 for a period of 2 months. We are asked to calculate the effective interest rate. Let's go step by step. First, calculate the interest charged on the amount actually borrowed, which is $550,000. We multiply this by the annual interest rate of 8%. And since the loan is only for 2 months, we take 2/12 of the year. So the formula becomes $550,000 multiplied by 8% multiplied by 2 divided by 12. That gives us an interest amount of $7,333.30. Next, we calculate the commitment charge. This is the fee the bank charges on the unused portion of the line of credit. The total credit line is $1 million, and the company has used $550,000. So the unused portion is $450,000. The bank charges 0.25% per month, and the loan is for 2 months. So the commitment fee is $450,000 multiplied by 0.25% multiplied by 2. This gives us a fee of $2,250. Now, let's calculate the total interest cost. This includes both the loan interest and the commitment fee. So we add $7,333.3 plus $2,250, which gives a total of $9,583.30. Finally, let's calculate the effective interest rate. This is simply the total interest cost divided by the amount actually borrowed. So, we divide $9,583.3 by $550,000, and the result is 0.0174, or 1.74%. So, the effective interest rate for this 2-month borrowing period is 1.74%. This example shows how commitment fees on unused credit can increase the overall borrowing cost even if you don't use the full credit line. Always consider both the used and unused portions when calculating effective cost under a line of credit. Now let's talk about another type of short-term financing called a transaction loan. A transaction loan is a type of loan where the bank directly finances a specific transaction on behalf of the borrower. What makes it different from other loans is that there is no direct cash flow to the borrower's bank account. Instead, the bank pays the amount directly to the seller or the vendor as part of the transaction. In other words, the funds do not go into the company's hands, they go straight to complete a particular purchase or contract. That's why it's called a transaction loan, because the loan is tied to a specific transaction. Let's take an example to make this clearer: a vehicle loan. When a business applies for a vehicle loan, it doesn't receive the loan amount in cash. Instead, once the loan is approved, the bank pays the car dealer directly, and the vehicle is delivered to the business. The business now owns the vehicle, but it must repay the loan amount, usually in installments, over the agreed period, including interest. This kind of financing is very common when companies buy assets like vehicles, machinery, or equipment. The asset becomes the security or collateral for the loan, and the bank controls the funds to ensure they are used for the intended purpose only. Transaction loans are useful when a company needs financing for a specific purchase, and both the borrower and the bank want to ensure that the money is used strictly for that purpose. So, to summarize, in a transaction loan, the bank finances a specific deal or purchase. There is no cash given to the borrower directly, and the bank typically pays the vendor or supplier on the company's behalf. Let's talk about secured loans, a very important category of financing where the company provides some form of security to the bank in exchange for getting the loan. A secured loan is a loan where the company pledges an asset as collateral. This means the company offers an asset it owns to the bank as a form of guarantee. If the company fails to repay the loan, the bank has the right to take control of the asset and sell it to recover the loan amount. The asset that is pledged as security is called collateral. Now, depending on the type of asset that's pledged, secured loans can be classified into 3 types. First, mortgage loans. This type of secured loan involves immovable property as the collateral. Immovable property means fixed assets like land, buildings, warehouses, or factories, basically any kind of real estate. In a mortgage loan, the bank holds legal rights over the property until the loan is repaid. If the company defaults, the bank can sell the property to recover the money. Second, chattel mortgage loans. In this case, the secured asset is immovable property. Movable property includes things like vehicles, machinery, equipment, or even commodities. Here too, the asset is pledged to the bank, and the company keeps using the asset, but the bank holds a legal claim over it until the loan is fully paid back. This is commonly used for asset-based loans, where specific equipment or movable assets are financed. Third, floating lien. This is slightly different. A floating lien is used when the collateral is a fluctuating or changing asset. Examples include accounts receivable, inventory, or stock and trade, things that are not fixed and can change in value or quantity on a regular basis. In this case, the bank places a claim over the category of assets rather than a specific item. As the company continues to operate, the individual items may change, but the lien remains on that general asset class. So to summarize, in a secured loan, the lender is protected by the value of the pledged asset, and based on what type of asset is used as collateral, the loan can be structured as a mortgage loan, a chattel mortgage, or a floating lien arrangement. Now let's look at another short-term financing method, known as factoring of accounts receivables. Factoring is a process where a company sells its accounts receivables to a third party, known as a factor, in exchange for immediate cash. This method allows the company to improve its cash flow without waiting for customers to pay their invoices. When a company sells goods or services to its customers on credit, it means the customer doesn't pay immediately. Instead, the company creates credit by allowing the customer some time, say 30 or 60 days, to pay the invoice later. This credit creates a risk for the company. Because the money is not received immediately, the company has to wait to get paid. Meanwhile, it still needs cash to pay its own expenses like salaries, suppliers, rent, and so on. This waiting period can create cash flow problems. Also, there is a risk that some customers may delay payment or even default, meaning they may not pay at all. This uncertainty and delay can make managing business operations difficult. This is where factoring helps. Factoring is a financial service where the company sells its accounts receivables, that is, the money owed by customers, to a third party called a factor. By doing this, the company gets cash immediately, instead of waiting for the customers to pay later. This improves the company's cash flow and reduces the risk of non-payment because the factor takes on the responsibility to collect payments from the customers. Now, here's how the factoring process works step by step. First, the company delivers goods or services and issues an invoice to the customer, creating the receivable, the right to get paid in the future. The company then sends this invoice to the factor to request funding. The factor advances about 80 to 90% of the invoice amount immediately to the company's bank account. This gives the company quick access to working capital. Customers are instructed to send their payments to a lockbox system controlled by the factor. This is where the factor collects the payments. Once the factor collects the full amount from customers, it releases the remaining 10 to 20% to the company after deducting a small fee for the factoring service. In summary, factoring helps companies avoid cash flow problems caused by waiting for customer payments. It transfers the risk of late or non-payment to the factor and provides the company with quick access to cash, so the business can operate smoothly and grow. Now let's understand a specific type of factoring arrangement called factoring with recourse. In this type of factoring, the risk of non-payment by the customer still remains with the company. This means that even though the receivables are sold to the factor, the company is still ultimately responsible if the customer fails to pay. Let's break that down. When a company uses factoring with recourse, it sells its accounts receivables to a factor and receives an advance, just like in regular factoring. The factor then tries to collect the payment from the customer. But here's the key point. If the customer does not pay, for example, due to insolvency or dispute, the company must repay the uncollected amount to the factor. So, the factor does not take on the credit risk. They're only providing financing and collection services, but if anything goes wrong with customer payments, the company bears the loss. Because the factor is taking less risk, the factoring fee is lower in this type of arrangement. That's why some companies prefer this option. It's more affordable in terms of fees, but it requires the company to take responsibility for bad debts. And here's another important accounting point. Since the company still carries the risk of non-payment, it must continue to maintain an allowance for doubtful accounts in its books, just like it would in regular credit sales. This allowance is used to estimate potential losses from customers who may not pay. So in summary, factoring with recourse means the company receives early cash, but if the customer defaults, the company has to pay the factor back. The factoring fee is lower, but the risk of uncollected amounts still stays with the company. Now, let's look at the second type of factoring called factoring without recourse. In this arrangement, the company sells its receivables to the factor, and if the customer fails to pay, the factor bears the loss, not the company. This means the factor takes on the full credit risk. Once the receivables are sold, the company has no further responsibility, even if the customer becomes bankrupt or refuses to pay. Since the risk of non-payment is transferred to the factoring fee is higher in this case. The factor is charging more because they are accepting more risk. From the company's point of view, this is safer and more convenient. It not only provides immediate cash flow, but also protects the business from possible bad debts. And here's another key point. Since the company no longer carries the risk of non-payment, it does not need to maintain an allowance for doubtful accounts. The receivables are completely removed from the company's balance sheet, and the factor takes over both the collection and the risk. So to summarize, in factoring without recourse, the company sells its receivables and is not liable if the customer doesn't pay. The factor takes the full risk, charges a higher fee, and the company enjoys both cash flow and risk protection, with no need to maintain any bad debt allowance. Now let's talk about the different charges associated with factoring. When a company uses factoring to improve its cash flow, it also needs to understand the costs involved. Factoring is not just a flat fee. There are multiple types of charges that can apply depending on the arrangement. Let's break them down one by one. 1. Factor's fee as a percentage of accounts receivable sold. This is the basic service charge the factor takes for handling the receivables. It is usually expressed as a percentage of the total invoice value sold to the factor. This fee covers services like reviewing the creditworthiness of customers, managing collections, and taking on credit risk, in case of non-recourse factoring. The exact percentage may vary based on the risk level, the industry, or the size of receivables. 2. reserves against potential sales returns. If the company's customers have the right to return the goods and the return period hasn't expired yet, the factor may choose to hold back a portion of the payment. This is called a reserve, and it's meant to protect the factor in case the customer returns the product. Once the return policy period ends and no return is made, the factor releases this withheld amount back to the company. This is important in industries like electronics, clothing, or retail, where product returns are common. 3. Interest charged by the factor. Apart from the service fee, the factor may also charge interest if the company wants to access the funds before the average maturity period of the receivables. In other words, if the company wants early payment, for example, right after selling the invoice, but the receivable is due 30 or 60 days later, the factor will charge interest for giving the money in advance. This interest is usually calculated like any other short-term borrowing, based on the number of days the funds are advanced ahead of maturity. So in summary, the charges in a factoring arrangement typically include a fixed fee for the service, a reserve held for any possible returns, and interest if early funding is requested before the receivables are due. Understanding these costs helps the company make informed decisions and evaluate whether factoring is the right choice for its financing needs. Let's now understand how to calculate the net proceeds a company receives from factoring its accounts receivable. When a company sells its receivables to a factor, it doesn't receive the full invoice amount right away. Certain charges and deductions are made before the funds are transferred. So it's important to know what exactly the company gets in hand. That's what we call the net proceeds. Here's how the calculation works. We start with the face value of the accounts receivable. This is the total amount of invoices being sold to the factor. From this, we subtract the following. 1. Factor's fee. This is the percentage fee the factor charges for their services. It's deducted right away from the invoice amount. 2. Reserve against sales returns. If customers are allowed to return goods, the factor holds back a certain amount as a reserve. This is a temporary deduction and may be released later once the return period ends. What remains after these two deductions is the cash deposited by the factor into the company's bank account. Now, if the company requests to withdraw this cash before the maturity of the receivables, then the factor also charges interest for giving the funds in advance. That interest is also deducted. So finally, the amount the company receives after all these deductions is called the net proceeds from factoring. To put it all together, the formula can be understood like this. Net proceeds equals face value minus factors, fee minus reserve against sales, returns less interest if withdrawn early. This gives us the actual amount of cash the company receives through the factoring arrangement. Let's now go through a sample question to understand how to calculate the net proceeds that a company receives when it uses a factoring arrangement. In this example, we will include all the key components, such as the factor's fee, reserve against sales returns, and interest charges for early withdrawal of funds. Here's the question. A factor charges a 4% service fee and also holds back 7% as reserve against possible sales returns. The face value of the accounts receivable being factored is $150,000. The average collection period is 120 days. The company decides to withdraw the funds early on the 30th day, and the factor charges 12% annual interest for any early withdrawal. We are asked to calculate the net proceeds the company will receive from this factoring arrangement. Let's go step by step. Step 1, calculate total fees. The factor is charging 4% as their service fee and also keeping 7% as reserve. So, total deductions are 4% plus 7%, which equals 11% of the face value. Now, calculate 11% of $150,000. $150,000 multiplied by 11% equals $16,500. So, $16,500 is the total amount being held back by the factor as part of fees and reserve. Step 2, cash deposited to company's account. Now, we subtract this from the face value. $150,000 minus $16,500 equals $133,500. This is the amount the factor initially deposits into the company's bank account. Step 3, calculate interest for early withdrawal. The company is withdrawing the funds on day 30, but the average collection period is 120 days. That means the cash is being withdrawn 90 days early. the factor charges 12% annual interest for such early funding. So, interest for 90 days is calculated as 133,500 multiplied by 12% multiplied by 90 divided by 365. That gives us approximately $3,950. Step 4. Calculate net proceeds. Now we subtract this interest from the earlier deposited amount. 133,500 minus 3,950 equals $129,550. So, the final net proceeds that the company receives from the factor is $129,550. This example clearly shows how factoring charges, including service fees, reserves, and early withdrawal interest, all affect the actual amount of cash received by the business. Understanding this calculation is key to evaluating whether factoring is a cost-effective solution for managing short-term cash needs. To really master this concept, it is important to practice more similar questions. With enough practice, you will gain the confidence to solve factoring problems quickly and accurately in your exams. Now let's talk about another form of short-term financing called inventory financing. Inventory financing is a loan or credit facility provided by a banker against the value of the company's inventory. In this arrangement, the banker technically owns the inventory, and the company simply acts as a commission agent, meaning it handles the storage and sale of the goods on behalf of the bank. The logic behind this setup is that the inventory serves as collateral for the loan. If the company fails to repay the amount, the bank has the legal right to take possession of the inventory and recover its money. Let's understand this better with a simple example. Suppose a company deals in electronic goods, like mobile phones and accessories. To maintain stock, the company needs to purchase a large quantity of products in advance. However, it may not have enough working capital to do this. So, the company approaches a bank for inventory financing. The bank agrees to finance the inventory purchase, but with one condition: the inventory will be held in the name of the bank until it is sold. The company can continue to store and sell the inventory as usual, but technically, it's acting as a commission agent for the bank. As the goods are sold, the company remits the proceeds to the bank. After deducting the loan amount and any interest, the remaining margin is returned to the company as its profit or commission. This kind of financing is especially useful for businesses with high inventory turnover, such as retailers, wholesalers, or seasonal businesses that need to stock up in advance. So, to summarize, the bank provides funds to finance the inventory. The inventory serves as collateral and is technically owned by the bank. The company acts as an agent, handling the sale and storage. As goods are sold, loan repayment is made from the sale proceeds. Inventory financing helps companies maintain sufficient stock without blocking large amounts of cash, while giving banks the security of physical goods to back the loan. We've covered a lot in this topic, and now it's time to bring everything together. Let's take a quick look at all the major types of short-term financing options we've discussed, organized in a simple chart to help you remember them in order. Number 1, trade credit. This is the most basic and widely used form of short-term finance, where suppliers allow the business to buy now and pay later. No formal agreement with the bank is required here. Number 2, short-term bank loans. This includes several structured loan arrangements provided by commercial banks. Under this category, we looked at loans with compensating balance, both with interest and without interest. In these, the bank requires the borrower to maintain a minimum balance, which affects the effective cost of borrowing. Discounted loans, where the interest is deducted up front, and the borrower receives less than the face value of the loan. Installment loans, where the borrower repays in equal monthly installments that include both principal and interest. These are structured based on the present value of future payments. Line of credit, which includes 2 forms. Revolving line of credit, where repaid amounts become available again, like a credit card. Non-revolving line of credit, where the credit once used cannot be accessed again. Transaction loans, where the bank directly pays for a specific transaction, such as a vehicle loan, and the business doesn't receive cash directly. Secured loans, where the company pledges assets as collateral. This includes mortgage loans, backed by immovable property like land and buildings. Chattel mortgage loans, backed by movable assets like vehicles or machinery. Floating lien, secured by fluctuating assets like inventory or receivables. Next, we looked at other types of short-term financing, which include Factoring, where the company sells its receivables to a factor for immediate cash. In factoring with recourse, the company bears the risk of customer non-payment. In factoring without recourse, the factor takes the credit risk and charges a higher fee. And finally, inventory financing, where the company uses its inventory as collateral. The bank finances the stock, and the company acts as a commission agent during the sales process. Each of these short-term funding methods has its own features, benefits, and costs, and businesses often use a mix of them depending on their cash flow needs, creditworthiness, and working capital cycle. So, now that we've gone through everything, you should have a strong foundation to identify, compare, and evaluate different short-term financing options, both in exams and in real business scenarios. Keep practicing the problems and reviewing the logic behind each financing tool. That's the key to mastering this topic. Thank you for watching this episode. Don't forget to like, share, and subscribe for more CMA exam coaching. See you in the next video.